July 2016. Verizon signs a $4.83 billion agreement to acquire Yahoo. In that purchase agreement, Yahoo makes a formal representation. They state in writing that there have been no significant data breaches. That was a lie, and Yahoo knew it was a lie. They'd known for nearly 2 years 500 million user accounts were compromised. A state-sponsored actor was sitting in their systems. They knew, and they signed the rep anyway. 2 months after signing, Yahoo was forced to publicly disclose the breach. 3 months after that, a second breach came out. Another billion accounts. By the time the deal closed, Verizon had clawed back $350 million and pushed half the breach-related legal liability back onto Yahoo. The SEC later charged Yahoo with securities fraud over the delayed disclosure, and they paid a $35 million settlement. Now here's the part that most people miss. Verizon didn't catch this in the due diligence. Their diligence missed it. The misrepresentation held all the way through signing. What saved Verizon was a public disclosure that Yahoo was eventually forced to make. If that disclosure hadn't happened, Verizon closes at full price. They inherit the breach, and they don't even know it. And this is the pattern that plays out in M&A deals all the time. Most don't make the headlines, and most don't have a company like Yahoo involved. But most also don't get a forced disclosure that saves the buyer from themselves. You see, that's the deal you didn't know you made. I'm David Shaw. Welcome to the Rook. This show is for the people who own security risk when security isn't their day job. It's the company founders. It's the investors, the executives, the boards. If that's you, you're in the right place. You'll get no product pitches here, no jargon that you have to translate, just intelligence you can use that same day, whether you ever pick up the phone or not. So let's get into it. In September 2016, Marriott had just completed its acquisition of Starwood Hotels and Resorts. It was a $13 billion deal, and it made Marriott the largest hotel company in the world. They had 11 new brands, over 5,500 properties, and, unknown to anybody in the deal room, Chinese state-sponsored attackers who'd been sitting inside Starwood's guest reservation system since 2014. That's 2 years before the acquisition. The attackers were already inside. Marriott didn't find them at close. Didn't find them 6 months later. They found them in September 2018, 2 years after the deal closed. By then, the attackers had exfiltrated data on 383 million guests, including over 5 million unencrypted passport numbers. The financial damage? £18.4 million in UK fines alone. $52 million to a coalition of US state attorneys general. They had an FTC consent order requiring a mandated security overhaul that Marriott is still operating under. Class action litigation is still ongoing. And that's all before you count the brand damage or the internal cost of a decade of remediation. But here's what makes this story so uncomfortable for acquirers, or it should. Starwood was a sophisticated company. Marriott was a sophisticated acquirer. The standard pre-acquisition cyber assessment didn't catch a state-sponsored compromise that had been sitting in Starwood's network for over 2 years. The attackers stayed in, the deal closed, and Marriott inherited the breach. Now let's think about that for a minute. If Marriott can miss a 2-year-old state-sponsored compromise on a $13 billion deal, what do you think is happening on the $40 million deal your firm is closing next quarter, where the diligence is a questionnaire? The IT manager fills out the questionnaire and everybody signs off. But here's the thing about questionnaires. They generally ask the right questions. Do you test your backups? Do you have an offboarding process? Have you had any incidents in the past 3 years? Those questions are fine. The problem isn't what gets asked, it's what gets accepted as the answer. It's very easy for somebody to check off, yes, we test our backups quarterly. Well, great. Did the test actually run? Did it recover systems to a working state, or did it just verify that the files exist? Who ran the test? Can they show you the report? Or, yes, we have an offboarding process. Did anyone follow it? Can you produce a list of every employee who left in the last 24 months and confirm that they didn't retain any of their access after they left the organization? Or, no, we haven't had any incidents. What about incidents that may not have been raised to the level of material or publicly reported? And are you sure you'd know if you did have an incident? You see, questionnaires create documentation, but it can't create assurance. The IT manager filling it out has every incentive to check the boxes, but your diligence has to verify what's behind the boxes. Now, 3 things have changed that make this a more expensive problem to ignore than it was even 2 years ago. First, representations and warranties insurance, which is now standard in middle market deals, is increasingly carving out cyber-related claims, or at least conditioning coverage on proof that reasonable diligence was performed. In plain English, if you skip the cyber assessment and there's a breach, post-close, your R&W policy may not respond. Second, cyber insurance underwriters are not writing blank checks for inherited risk. Policies now routinely include pre-existing condition exclusions. If the breach originated before the policy inception date, you may be entirely on your own. For remediation, for notification costs, regulatory response, for litigation, and in a Marriott-Starwood scenario, that breach originated 4 years before the policy. And third, a 2026 industry study found that 84% of M&A professionals anticipate increased cybersecurity scrutiny and due diligence over the next 12 to 24 months. Now, that's not a fringe view, that's consensus. And it's filtering down to the middle market. You know, the big 4 consultancies have built dedicated cyber transaction practices. The cybersecurity due diligence market itself is growing toward $8 billion a year. R&W underwriters are pricing cyber risk into every policy. But here's the gap. By at least one industry estimate, only about 10% of M&A deals get a thorough cyber due diligence assessment. 10%. Now, most of the price adjustments and renegotiated structures from cyber findies won't make the headlines. They'll happen in confidential rooms. But the deal your firm is closing next quarter is going to face questions that didn't exist 3 years ago. So if you're a buyer, the question is whether you're doing the work. If you're a seller, the question is whether you can prove you already did. The cost of a thorough pre-deal cyber assessment is a fraction of what a single inherited breach demands in terms of remediation, legal exposure, reputational repair. And the market has arrived at a clear position. Cyber risk is a valuation driver, not a compliance footnote. So if the questionnaire isn't enough, what is? Well, let me walk you through what cyber diligence looks like when it's done right. I'll give it to you in the order the work happens, because timing matters. Now, this isn't a checklist you hand someone at signing. It's a 4-stage process that runs alongside the deal, from the first conversation through close. Stage 1. This happens before you even signed a letter of intent. It's called passive reconnaissance. No credentials, no system access, no NDAs required. It's all open source. You're just looking at the target's external attack surface the way an attacker would. What servers are exposed to the internet? What software versions are they running? Have their domains shown up in known breach data sets? Are there old credentials floating around on the dark web markets? This takes a few hours and costs almost nothing, and it tells you one critical thing before you commit. Is cybersecurity going to be a normal diligence workstream here, or is it a deal stopper conversation? Now, I've seen pre-LOI passive reconnaissance surface a target with active ransomware infrastructure indicators on day one. That's not a deal you want to touch without renegotiating the structure. You want to know that before you've spent $200,000 on legal and financial diligence, not after. Now, stage 2 starts after the LOI. So this is after you have the NDAs and the data room access. This is the technical assessment, and it runs on 2 tracks simultaneously. The technical track is the one most people think about. It's the endpoint security, identity and access management, patching cadence, network segmentation, backup integrity, incident history. But the question isn't, do they have tools deployed? The question is, are the tools working, and does anyone check? I've walked into environments with every best-in-class security product installed, and all of them are either unconfigured or generating alerts that nobody reads. So checkbox security is not security. The governance track runs in parallel, and it asks a different question. Does the company actually operate like a security program exists? Do they have written security policies that reflect actually what people do? Do they run annual training? Have they ever tested their incident response plans? Not, do you have a plan? But have you ever run a tabletop exercise and watched your team try to execute it? The answers here are all diagnostic. A company with mediocre tools and a strong security culture will recover much faster from an incident than a company with expensive tools and no culture. Stage 3 is compliance and regulatory mapping. Now, this is critical for regulated targets: healthcare, financial services, government contractors, media companies handling production IP. You need to know where they actually stand, not where the marketing materials say they stand. Are they PCI compliant if they take cards? If they hold PHI, are their business associate agreements current and signed? If they're a government contractor, where are they on the CMMC path? And is the timeline credible? Compliance gaps are some of the most material findings in cyber diligence because they translate directly into known remediation costs and known regulatory timelines. Those are numbers your deal team actually can use. Which brings me to stage 4. And this is the one most cyber consultants skip because it requires speaking M&A language instead of security language. Every finding has to be translated into one of 3 buckets. Bucket 1, deal stopper. Something so material that the transaction either needs to be renegotiated or walked away from. Things like an active compromise, ongoing litigation from a prior breach, regulatory sanctions in progress. Bucket 2, value adjustment. A quantifiable remediation cost that should come out of the purchase price, or at least be held in escrow, or maybe even be addressable by specific reps and warranties. Bucket 3, known risks. Now these are the ones that are managed post-close. It's an issue that's real, but not deal threatening. It has to have a documented 100-day plan and an owner assigned to it before the close. That's 3 buckets. That's the output investment committees need. Not a 40-page technical report, 3 buckets, dollars attached, decisions required. If your cyber diligence provider isn't giving you that, if they're not translating their findings into deal team language, you're not getting diligence, you're getting an expensive technical audit. Now, if you're on the sell side, because half of you listening are founders or executives who might be the target in the next 2 to 4 years, the single most valuable thing you can do right now is get audit ready before anyone asks. Not because a deal is imminent, but because a documented defensible security posture is a value preservation tool. When a buyer shows up and you can produce a current SOC 2 report, a recent penetration test with remediation status, and a documented incident response plan you've actually tested, along with a clean identity environment and MFA everywhere, no orphaned accounts, you've just compressed your diligence timeline by weeks and removed half of the common reasons for purchase price adjustment. The specifics: if you're a SaaS business or you handle client data, get your SOC 2 completed. If you haven't done a penetration test in the last 12 months, do one. And more importantly, resolve the critical findings. Document your incident response plan and run a tabletop exercise against it, even if the exercise is just you and 2 other people in a conference room for an hour. Clean up your identity environment, remove accounts for people who have left, enforce MFA across every system that supports it, and document who holds privileged access and why. Now, none of this is expensive. Most of it you can do with the team you already have. And all of it reduces your operational risk today, whether a transaction ever happens or not. So when a transaction does happen, it shifts the dynamic at the negotiation table from defense to confidence. Those are not small things when you're sitting across from a buyer negotiating final terms. Okay, before I close out today, I want to leave you with something that you can use. I just spent 2 segments telling you the problem with M&A cyber diligence isn't the questions. It's what gets accepted as the answer. So let me give you the practical version of that. Here's 3 things that you should require from the target. Not questions to ask them, but 3 things they have to produce. So number 1, a documented log of every cybersecurity event the company has evaluated in the past 3 years. Not material events, every event the company looked at and made a call on, including the ones they decided weren't material. Now that log may not exist for most middle market targets, and that in itself is the answer. But if the company doesn't have a process for tracking incidents, that means they don't know what they've had. If they do produce a log, you've at least got somewhere to start. Look at the events they decided weren't material. That's where the buried problems live. Now, number 2, you want a current inventory of every third party with privileged access to production systems or core data, with a date showing when the inventory was last validated. Again, this inventory often doesn't exist as a current document. They have a list somewhere, it's in a SharePoint folder that someone updated maybe 14 months ago when they did their last vendor review. A stale inventory is not the same as an inventory. If they can't tell you who has access today with confidence, that's an inherited risk you're about to own. And number 3, the last 2 years of penetration test reports, plus a remediation tracker showing the current status of every critical and high finding from those reports. Notice what this is asking for. Not whether they did a pen test. The reports themselves, plus the tracker that shows what they did about the findings. If they hand you the reports and there's no tracker, the answer is they didn't fix anything. If they hand you the tracker and the criticals from 18 months ago are still open, well, you just found a material risk that no rep would have surfaced. 3 artifacts, not 3 questions, 3 artifacts are the evidence. The questions are just a way to ask for that evidence. If the target can produce all 3 cleanly, you're working with a serious counterparty. If they can't, you've just learned something that a questionnaire would never have told you. Well, that's episode 1 of the Rook. If you take one thing from this episode, take this. Cyber risk doesn't reset at closing. It just transfers to a new owner. If this episode was useful, the most valuable thing you can do is send it to one person on the deal team who needs to hear it. That's how this show grows, and that's how this work reaches the people it's meant for. If you're working on a deal right now and you want an independent view of the target's security posture, or you're a founder who wants to get ahead of the diligence conversation before a buyer shows up, you can reach me at corvus-cyber.com. We drop new episodes every Tuesday. I'm David Shaw. This is The Rook. And now, it's your move.